Welcome to the series Conversations on Central Banking. This is a series organized by the Master of Central Banking program. It's a one-year residential program designed especially for central bankers, including 6 weeks of immersion at MIT Sloan. Let me just mention an upcoming webinar, which is part of the series. On November 4, we're going to have a discussion of how the integrated policy framework might benefit emerging economies. We will have Jose de Gregorio, former governor of the Central Bank of Chile, and we will have Viratai Santiprabob, former governor of the Bank of Thailand. So those are the webinars that are coming up. As you all know, the topic for discussion today is bloated central bank balance sheets. Hamid, can you go to the next slide? The chart shows the evolution since 2015 of the balance sheets of the world's major central banks. These balance sheets are now bigger than ever. Together, the US Federal Reserve, the European Central Bank, and the Bank of Japan now hold over 21 trillion US dollars in assets on their balance sheets. This is an unprecedented amount relative to the size of the underlying economies. In the case of the Bank of Japan, as you can see from the red line on the left, that's about 120% of Japan's GDP. In the case of the ECB, that's about 90 to 100% of the euro area's GDP. That's the yellow line. The blue line is the Fed. It's holding about 70% of US GDP. This buying spree really started in 2008 in response to the global financial crisis. This slowed down a bit as the world recovered from the crisis. But when the pandemic arrived in 2020, the central banks resumed their asset purchases. Not just the Fed, ECB, and Bank of Japan, but also the Bank of England, the Bank of Canada, the Reserve Bank of Australia, and some of the emerging market central banks. The chart on the right shows how much of the outstanding amount of government debt is held by 4 central banks: the Fed, the ECB, the Bank of Japan, and the Bank of England. As you can see, the Fed and the ECB are holding somewhere between 25 and 30% of the government debt in their economies. Japan is holding 50% of Japanese government debt, the Bank of Japan, and then the Bank of England is holding close to 20% of UK debt. In this webinar, our two eminent panelists will discuss the consequences of such balance sheets and outline what should be done going forward. They will introduce the issues for roughly 10 minutes each, and then we will open the floor for questions. The best way to send us your questions is probably through the chat box, which we will monitor. Let me briefly introduce our two panelists. Both are members of the advisory board of the Master of Central Banking program. Glenn Stevens was governor of the Reserve Bank of Australia from 2006 to 2016. He is also a recreational pilot. Glenn, you told me this. And he flies for a charity organization called Angel Flight. Athanasios Orphanides was governor of the Central Bank of Cyprus from 2007 to 2012, and thus was a member of the governing council of the European Central Bank. He is now professor of the practice of global economics and management at the MIT Sloan School. We are fortunate to have them as our panelists today. Both of them served as governors during the global financial crisis, and they would know what it means to lead a central bank during difficult times. Let me now turn first to Glenn Stevens to offer his opening remarks.
Oh, well, thank you very much, Eli, and thank you to the school for the invitation to be here. And it's a pleasure, and it's a pleasure to be sharing the platform with Athanasios. I thought to begin, I might talk about really three questions, a fourth if there's time, but three to begin. How did we get here with these large balance sheets? Secondly, is it a problem? And if so, why and in what way? And then thirdly, what we should be looking to the future, how we should look to the future as we go forward. So how did we get here? And I think it's instructive actually that the Bank of Japan, I think, really showed us the future way back probably 20 years ago now, when interest rates at the short end, the policy rate got to zero. They had the ZIRP, the so-called zero interest rate policy. And then because that wasn't enough to foster the kind of strength of recovery that they were seeking, the question came, what else can we do? And quantitative easing, so-called, was entered into the lexicon. And I think it's fair to say that most other central banks watched what was happening in Japan back then, tried to gain an understanding of the situation, and were silently praying that they would never face it themselves. Fast forward, of course, to 2008, and in many cases, with the depth of that shock, the policy rate at the short end did get to zero, and a number of countries, not my own at that stage, but a number of major countries were faced with trying to do more to help the economy. I think, therefore, and then subsequent to that, of course, it's been a struggle, really, for monetary policy to get inflation to go back up to targets. I think it's probably the case in many jurisdictions that inflation is, if anything, too low. It's proven quite difficult, despite all the quantitative measures that have been done to get inflation to go up. So a few countries were really able to exit QE. The Fed briefly managed to, but not for long, and they had to reverse course before they had gotten very far. So when this crisis came, even though this crisis is first and foremost a health crisis and a supply shock, in the sense that governments have dictated that the supply side of the economy, or large parts of it, had to be shut down. Nonetheless, central banks have been faced with contraction, the likelihood that inflation would fall further, and the need to at least assist in responding to that. So we've got here, by a combination of low rates or zero rates in many cases going into this shock, inflation still, if anything, more likely to be too low than too high. And we've had also, of course, some serious market dysfunction earlier this year that saw central banks need to respond by dealing very actively in markets that normally are extremely liquid and well functioning, like government bond markets in their own currencies, including the US Treasury market. So for a whole host of reasons, as Eli showed on the chart, central bank balance sheets have become very large. And my point, I guess, is that this has been coming for a while. It's been happening in Japan for quite a long time now, with no sign that they will be able to exit anytime soon. This is the world we're in. Is it a problem? Well, it's not necessarily a problem directly in itself. It isn't as though the central bank is somehow going to run out of money. The central banks, if you have your own currency, you have the privilege of creating that money, that currency, to the extent you judge appropriate. So in that sense, while ever the general public is willing to accept the obligations that the central bank is issuing in the form of money, it's not a problem. It's not a problem funding the balance sheet. And I think we'd have to say that the alternative of not having done these measures in the face of the shock we have faced would be worse. I don't think central banks could have stood by and just said that because interest rates have now reached the zero bound or close to it, that's it, there's nothing more we can do. I think they were duty bound to assist in any way they could with the circumstances we face, even though the shock per se is not in its first manifestation anyway, a demand shock. And even though in this episode, it's going to be fiscal policy in most places that bears the main burden of stimulating demand, nonetheless, central banks, I don't think could have sat back and said, we're not doing anything here. That would not have been consistent with their mandate. It wouldn't have been acceptable to their populations. So it had to be done. It does, of course, bring risks. Central banks have taken on much more interest rate risk. In some cases, they're taking more credit risk than they might once have. There's an additional risk, I think, in the form of, I suppose it goes under the label of moral hazard. The more often central banks step in to calm market dysfunction, the more likely it is that markets will assume that will happen in the future, and the cost of not doing it next time in terms of serious dislocation for markets and the economy will be higher. That's a problem. That's always a problem, actually, with large-scale interventions. And I don't know that there's any real solution. If you are the governor on the day that this problem presents, it's very hard and I think rather risky to say, well, because I'm worried about moral hazard, I won't help them. I'll let the market sort it out themselves. Very difficult to do that, but it is a problem nonetheless. Each time these interventions occur to calm markets, the bar to doing it again, in a sense, goes down. Markets expect it more and more. So that's a potential problem. But the biggest problem, of course, is a political economy one, because the distinction, the boundary between fiscal and monetary policy, which used to be clear, I think at least in the advanced countries, the government funds itself in the market at the market rate. The central bank manages its own balance sheet. It does monetary policy mainly through interest rates. The two should work consistently and not against each other, but they're distinct. And the central bank's role and its independence was crystal clear. And that world is long gone. The boundary is much more blurred now between fiscal and monetary policy, because with the extremely large budget deficits that many countries are running, including my own, the central banks are ensuring that the funding of those deficits is very, very low cost, and that's appropriate. But that clear distinction between fiscal and monetary policy is much less clear than it used to be. And that raises the risk that when the time comes to stop doing this, and I don't think that day is any time soon, but we would hope that at some point these extraordinary interventions can at least be tapered down. So I think that's sometime in the future, but hopefully that one day that can happen. It's likely to be more difficult for central banks perhaps than it was in the heyday of independence of central banks, which I think is now in the past. So it's not a problem necessarily in itself that these balance sheets have got larger, but there are some risks. And I think longer term, probably the biggest one is preserving, or at least trying to return to, that clearer distinction between fiscal and monetary policy and avoiding fiscal dominance. Thirdly, then, what should happen in the future? I think that it's actually important for central banks to be clear that the answer to restarting growth in our economies and restoring economic activity is mainly not monetary policy. Monetary policy has a part to play. Central banks have a part to play, but it's a supportive role. the demand stimulus has to be mainly fiscal, I think. And not only that, to get full recovery, we actually need to reopen the supply side of our economies in a way that's safe, be that in some kind of COVID-safe fashion or with a vaccine or whatever it is. But until we can do that, it's not enough just to pump up aggregate demand, even though that's something we need to do. We actually need to free up the supply side of the economy for the vast numbers of service type jobs in the supply side to actually be restored. And it's important central banks, I think, are clear on what they can do, what monetary policy can do and what it can't do. Monetary policy has been seriously overburdened for quite a few years since the crisis in many countries, and perhaps even more so now. It's important for central banks to be clear on what they can do and what they can't do. And I think that needs to be embedded in a narrative about restoring economic activity, restoring growth, and much of that's about dealing with the health issues in a safe and balanced way. And to the extent we need demand stimulus, that's mostly going to need, in my opinion, to be fiscal. I think it's critical that this narrative also be surrounded by or embedded within a governance framework for central banks that preserves independence, that preserves the ability of the central bank when the time comes to say enough bond buying or what really amounts to monetary financing of governments. That's to a fair extent what's really happening. It's critical that the central bank's ability to determine how much of that to do remain intact. And so the governance is critical. There is a reason in history why there's been a taboo on central banks directly financing governments. We all know what that is. It's that governments typically find it hard to stop spending that created money once they start. That's why we've had a requirement for central bank independence. So it's critical that that governance structure be maintained. And I think that will be a challenge. And it's critical that the way forward is embedded within a growth narrative where we're clear on what we need to get economic recovery and what monetary policy can do and what it can't do. Thanks, Eli.
Thank you, Glenn. I think that was a very clear statement of the issues. Central banks almost had no choice but to come forward to step in, but now they have to deal with the moral hazard down the road, the political economy issue that you raised, Glenn. Let me now turn to Athanasios for his opening remark. Athanasios.
Thanks, Eli, and thanks for the introduction, and thanks, Glenn, for giving us this description of the problems. I could spend the next hour simply filling in the gaps and giving you my views on this. But let me go back and add a little bit to the history of how we got there. It's important to understand why we are here to help us understand what to expect going forward. First and foremost, as Glenn already mentioned, we have a health crisis in our hands, but this health crisis necessitated the public policy response of creating effectively a recession. And it's part a supply-induced recession, but part a demand-induced recession, the effect of shutting down economies all over the place. Now, regardless of the source, this is a very unfavorable outcome for the economy that does require a very forceful policy response. I agree with Glenn that in addition to the health issue, first and foremost, this is a situation where we need the fiscal authorities to step in. We need funding in the economy to sustain SMEs and households that may be in trouble temporarily. Part of it is because of the loss of liquidity, but part of it is going to be really insufficient demand, creating solvency problems going forward. But I have to say that we also need monetary policy response, and I want to describe separately two issues with monetary policy that are relevant. First, because we have been effectively in a crisis situation with fast-moving things, we needed the central bank to step in and implement some of what normally would have been a fiscal response. In some countries, I'm in the United States. I can talk a little bit about the Fed, for example. We have actually seen the Fed do effectively fiscal operations. When the Fed, in coordination with the Treasury, started effectively making available liquidity to businesses directly, which is not a normal central bank operation, but in time of crisis is an operation that you see. And part of the balance sheet increase, a small part, but it's still a part of balance sheet increase, is due to that. But the largest part of why we ended up with bloated balance sheets is the fact that we needed standard monetary policy easing, and that could not be implemented because of the very low interest rate environment we are in. So I want to spend a minute on the implications of the low interest rate environment and why this is something that we need to keep in mind for the foreseeable future, really. If I go back 30 years from where we are now, interest rates would have been 2, 3, 4 percentage points higher, depending on the country. And the monetary policy is, 300-400 basis points of cutting interest rates would have been an easy response of any central bank in advanced economies to do. And frankly, if we were in that environment 30, 40 years ago, I would not have expected a whole lot of balance sheet easing under the circumstances. Most of what we have seen could have been done with interest rates. Not all. Some of the crisis management interventions would have needed a little bit of balance sheet expansion, but not a whole lot. If I look at the Fed, for example, we've had a balance sheet expansion that was tiny in comparison to what we have right now with the Y2K preventive move as an example. So as Glenn pointed out, what we have seen in terms of balance sheet policies outside Japan is starting with a global financial crisis. Why is that? This is because central banks in many advanced countries, not in Australia with a global financial crisis, but we had this at the Fed, we had this in the Euro area, we had this in a number of other European economies, Bank of England and so forth. We had central banks that needed to cut interest rates all the way down to zero and then realize that that was not enough to provide the monetary accommodation they needed to provide. And at that point, and balance sheet expansion is the indicated policy, is the natural thing to do. And it's very, very important that actually central banks do this promptly. By doing the balance sheet expansion along these lines, central banks effectively reduce yields on longer-term instruments and boost asset prices. Again, we don't want to be boosting asset prices under ordinary circumstances, but we do want to be boosting asset prices under these circumstances because this eases financial conditions in the economy. And actually, by maintaining high asset valuations, ensures that the credit can flow in the economy more smoothly. So this is the key I want to focus my attention for a couple more minutes. If we were not in a very low interest rate situation, we would not be talking about bloated balance sheets right now. We are in a very low interest rate situation. The concept of the equilibrium real interest rate that would be the normal interest rate in the economy with a 2% inflation target, for example. It used to be something like a 5% in the United States. 5% Fed funds rate would have corresponded to a 2% inflation rate. Now we are being told by Fed staff estimates and the projections that are presented by FOMC participants that same natural interest rate, nominal natural interest rate, is maybe 2, maybe 2.5% with a 2% inflation. So it's very, very important to cut interest rates as much as you want, and then provide the additional accommodation. What are the consequences of not doing that? Well, if you don't do that, you will actually have inflation keep falling. You will potentially enter into a deflationary trap, which is something that we would all want to avoid. So let me actually use this opportunity to bring up one of the issues that Glenn pointed out is very, very important. Central bankers are, of course, uncomfortable engaging in quantitative easing and bloating their balance sheets for all of the reasons that Glenn mentioned before, the governance reasons, the questions about whether the central bank will manage to exit these very accommodative policies once you are in it. And the answer, in my view, again, building on what Glenn mentioned earlier, is to be systematic and to explain what the objective of the policy is and to effectively explain what the policy rule is that will guide future policy. So one very simple way to think about it would be to first explain what is the central bank's definition of price stability, what is the central bank trying to do. In many countries around the world, you have an inflation goal that's clearly specified, 2% in the case of the Federal Reserve, for example, very, very clearly specified. The case of the RBA, 2 to 3% over the business cycle, not as precisely specified, but still pretty clearly specified. And if the central bank explains that really the rule for when the accommodation will be removed is when there are threats that inflation will exceed the inflation goal, that actually gives a lot of guidance to markets and can maintain the independence of the central bank without having to worry about when you would exit. It's much easier for the central bank to tighten policy under any circumstances when you can explain that you are tightening policy, because you would lose price stability if you don't. And this is one of the reasons why clear inflation objective and clear communication of monetary policy vis-a-vis that objective is actually a way that can also help central banks in this environment. So let me end by this introduction by saying that it's very important that central banks did move towards bloated balance sheets in this episode. Not doing that, which in the past we have had episodes where central banks have been reluctant to adopt quantitative easing measures, not doing that is really leading to a recession that can have very long-lasting adverse consequences, which we would want to avoid. So it may be more comfortable for central banks sometimes not do the risky and difficult things, but the economy suffers, and central banks are not doing their jobs if they do not take what may be perceived as risky for whatever reason. And I'm bringing this up because the question of moral hazard, when this thing comes up, moral hazard is a very important issue, but moral hazard should not be stopping central banks from actually doing the right thing. Moral hazard should guide us towards being more systematic and communicate the policies that central banks follows, but not avoid the hard decisions and doing the right thing. Let me stop here.
Thank you, Athanasios. I think your discussion complements what Glenn said. You emphasized the need to ease in an environment when interest rates are already so low, and so there was no other way to do it but to expand the balance sheet. And then you emphasized having a clear exit strategy, explaining how you would reduce the balance sheet in the future. I think Glenn was emphasized the future that's further down the road, about defining the role of the central bank in a growth narrative. Would that be a supporting role, Glenn, or would that be in the growth narrative? You kind of said it's a more of a fiscal role rather than a monetary policy role.
I think in this particular episode, the nature of the shock is such that the growth narrative that we have to craft as policymakers today is one, firstly, as I said, about managing the health matters, which is the original source of the problem, and then mostly the demand management from the fiscal side. And the central bank's part of that narrative, I think, is to say something along the lines of inflation's very low, possibly too low in some cases, and it's likely to remain low for quite some time. And while ever that is the case, we're going to be holding, extremely accommodative policies. This is, I think, dovetailing with what Athanasios said, talking about what the goal is. And it's probably too early today to talk about exit conditions. I think it's years away before that day comes, but a structured narrative about what the future holds, what the growth support is going to be, where it's going to come from, and the central bank's role is to just set out what its part will be in that narrative. And I think if you have done that, then you have the best chance, A, of succeeding in getting growth going, and B, in being able to carefully exit these extraordinary policies when the time comes, which, as I say, I think is quite some time away.
Yes. You want to add to that, Athanasios?
Well, let me add one thing about, we're talking about the current recession and expansion, or let's think ahead 20, 30, 40 years. Do we expect a similar monetary policy response? I think this all depends on what is the equilibrium real interest rate. If the equilibrium real interest rate for the next few decades, because of demographic reasons and low technological improvement, stay very low, then frankly, we need to get used to the situation where whenever we have a recession, central banks will be hitting the zero lower bound, and then they will need to be activating balance sheet policies to expand. If, on the other hand, we have a reversal of the reduction in the equilibrium real interest rates, productivity starts rising, for example, or the demographics around the world improve. This is not just advanced economies, this is the global demographics improve. Then with equilibrium real interest rate going higher, we will not need to be seeing balance sheet policies. I think it's very important to understand what the structural factors are in the background that are driving the need for these kind of policies versus the alternative. Again, much like Glenn and most central bankers I know, central bankers would be more comfortable if they don't have to engage in balance sheet policies, because they do have this feature, as Glenn pointed out, that they are to some extent fiscal in nature, and they make it much harder to separate monetary and fiscal policy. But as long as we are in the environment of very low interest rates we are right now, we're going to have to deal with this. This also brings one other thing: which countries need to do this and go there? And this is going to be countries that are actually affected by the structural reasons that make interest rates very low. The RBA, as Glenn mentioned before, did not have to do quantitative easing after the global financial crisis. Well, the recession wasn't really there in their case, but also interest rates were sufficiently higher that they didn't have to worry about that. So it matters what the underlying level of interest rates is to understand whether we need to be engaging into these policies going forward.
Right. Let me ask a question from Anela Monroe. It's almost 12 midnight where she is, so maybe she gets priority in terms of questions. She says the normal expectation would be that as the economy recovers, the government starts to repay the debt, and the central bank reduces its holdings of that debt. And then she has a two-part question. She says, when that repayment ensues, could the process lead to frictions? I think you both partly answered this question. But might these frictions be more painful when the debt is larger and the central bank balance sheet more bloated? And then she asks, is it conceivable that net repayment doesn't happen and the central bank maintains a bloated balance sheet indefinitely? In other words, could the central bank just monetize the debt for good? I think I'm putting words in her mouth, but that's kind of the question.
Yeah, so Eli, I'm going to start, if you allow me, with the very
please.
last point. You
Please.
don't need to monetize the debt in order to have the debt to GDP ratio asymptotically fall towards zero while you never sell the debt at the central bank. So what I'm trying to say here is that the debt ratios that we're all worried about are ratios. It's debt divided by GDP. And with good policy, GDP grows. And this is why it's so important to do these policies promptly when you have to do this. It's very important to have nominal GDP growing at a 5% rate over the next 10 years if you have a 2% inflation objective and 3% potential output growth, as opposed to a 3% growth rate. If you are not fighting the crisis and you actually let the recession persist for a very, very long time. Usually, in these situations, we are going to get debt problems if the monetary policy is not forceful enough and ends up with a deflation or a disinflation situation. So do you need to sell the debt? That depends on the structure of the economy later on. Frankly, in most cases, in advanced economies, I don't think you literally need to sell the debt. You may need to shrink your portfolio at the central bank, as the Federal Reserve did, for example, for a few years. If you need to tighten policy conditions. But frankly, you don't need to do that in order to restore norms in terms of the holdings of the central bank's assets, of the central bank share of government bonds. Let me give you an example in this regard. Before the global financial crisis in the United States, we had one more episode of a bloated balance sheet in the Fed's history. And this came in the 1930s. And the Fed actually messed that up very badly. Rather than applying quantitative easing at the beginning of the Great Depression, the Fed hesitated. This created deflation. And then the Fed needed to bloat its balance sheet much more, and after a decade of disaster in the economy, to restore stability. So again, we had a bloated balance sheet about the same size as we had in 2015, as a matter of fact, okay, in 1940. How did that get stabilized over time? The Fed didn't really actively pursue a reduction of the level of its balance sheet in the 1950s, 60s, 70s, 80s. Instead, it did normal policy, facilitating normal growth. It tried to keep inflation low. You had nominal GDP growth rates that were reasonably high. Even if you don't have the inflation of the 70s, you had like this 5%, 6% nominal GDP rates. And that was actually enough to allow nominal GDP to grow enough so that the size of the Fed's balance sheet shrank quite a bit 20, 30 years later. And that's a situation where, without selling any of the debt, the size of the balance sheet of the central bank relative to GDP was restored naturally to where it was before the Great Depression in that case.
Thank you, Athanasios. Would you say, Glenn, that Athanasios' exit strategy should be part of what you call the growth narrative?
Well, there's no doubt that the best way, and probably the only way out of a higher debt burden, now leaving aside the question of how much of it the central bank owns, in in situations where the debt to GDP ratio is a high number, like in wartime, the way out of that is to grow the economy. Rather than you can't consolidate your way out of that debt level. It is, so it's critical. Firstly, that the year-to-year deficits, once the immediate crisis has passed, that those deficits become of a more manageable size. I think if we keep budget deficits running at 10 to 12% of GDP every year for a long time, we're in a different world to the one that's being described here. But if those are temporary to meet the crisis and then they revert to smaller numbers, then you had a one-time rise in the debt to GDP ratio, and the way out of that is have nominal GDP grow. As Athanasios said, you want G to be bigger than R, and that's the way out, which I think raises the importance of productivity enhancing policies on the supply side to make sure that the potential growth rate of the economy, and by the way, the natural real interest rate as well, are as high as we can make them. Those sorts of things are really how countries like the US or my country, post-World War II, the debt ratio to GDP was 150% or something of that nature.
Yeah.
By the 1970s, it was quite a small number, and most of that was natural growth with modest deficits and surpluses year to year once the war had finished. That I think is the best model.
And fiscal policy would have a larger role to play, would you say? Or
Well, I think when Athanasios says that we'll have to get used to in future recessions, central banks doing more quantitative type things, I agree with that. But I think another thing we have to get used to is that fiscal policy needs to play more of a counter-cyclical stabilization role, not just leave it to the central bank. And so both of those things, I think, are a feature of this cycle, and that will remain the case while ever the neutral real interest rate remains very, very low. Definitely.
I have a question from, please, Glenn, please continue.
The only other point to note, I think, is fiscal policy, counter-cyclical stabilization, is you're supposed to ease a lot when the economy is weak, but you're supposed to go the other way when it's strong, rather than just run up a big deficit and then make it even bigger next time there's a downturn. It's supposed to be, stable in some sense, so that you can keep debt to GDP on a stabilizing trajectory in the long run.
Let me ask a question from Hans Genberg. I think this is related to the exit strategy. Hans says, if indeed the expansion of balance sheets was expansionary for the economy, as Athanasios suggested, would shrinking the balance sheets be contractionary? And if so, is there a way to do it so that it's not contractionary?
But I would say that, of course, shrinking the balance sheet is contractionary. And this is why shrinking the balance sheet is something that would need to occur only once the economy is beyond its recessionary stage, and inflation threatens to exceed the central bank's goal. So really, we can think about this in analytical terms as having two instruments. You have your short-term policy instrument, and you have your balance sheet instrument. You can tighten policy by raising the short-term interest rate, or you can tighten policy by shrinking the balance sheet. If we actually look, the Fed is one of the central banks that did some of each before the pandemic in the last few years until 2018, and we could see that. And there is some substitutability in the two instruments, both in easy monetary policy and in tightened monetary policy. So would you want to shrink your balance sheet if you do not have to tighten policy? No, you wouldn't. And I'm going to go back to Glenn. You want to have the conditions that will restore sustainable growth in the economy, and for that, fiscal policy. And I'm going to add to the fiscal policy component. This is a very great opportunity for many advanced countries to do this right now. Promote infrastructure investment that will raise productivity in the future. Actually, if you have fiscal and structural policies that raise our star, then that's going to be a way that in the future we will be able to get out of this.
Did you want to add to that, Glenn?
No, absolutely right. If we could get our star to go up, then you know, concerns about debt burden lessen, and concerns about monetary policy not having enough firepower also lessen. So it's, if we could get our star to go up, would be great. We have been talking about that for quite a long time, but if we could actually manage that through structural policies and infrastructure, sensible infrastructure investment, would be a good thing.
Thank you, Glenn. There's a question about hysteresis. If the balance sheet is so large, does it make it harder to raise interest rates? Is there, I guess the question is there a sequence to doing this? Do you reduce the balance sheet before you raise interest rates?
Well, I can have a go at that if you like.
Yes, please.
I think personally, my guess is the right approach is probably going to be to start to raise the interest rates before you start shrinking balance sheets. My feeling would be it's going to differ from country to country, and we don't know what the circumstances are going to be, but I would hazard a guess that just leave the balance sheet alone, and the central bank's balance sheet, which is very large as a share of GDP, much larger than normal, that will gradually shrink over time if we can get GDP to grow. And I think it would probably be preferable to re-establish some positive interest rates in the economy rather than fiddle around with trying to lessen the central bank's balance sheet. It's true that when you raise rates, the interest rate risk that the central bank has taken onto its balance sheet by holding all this long-term debt, the duration risk, that will hurt it. But the central bank has the strongest balance sheet of anybody, so it can absorb that effect. I wouldn't let that worry me as a central bank. I would just accept that, and I think it's probably going to be better to just re-establish modest positive interest rates if we can when the time comes.
Without reducing the balance sheet necessarily.
Yeah, the balance sheet will, it will be fine. I think I wouldn't be trying to get that down in order to kind of lessen my own balance sheet risk in the central bank. I think that's the wrong thing to do.
Yeah, so let me agree with Glenn that questions about the risks on the central bank's balance sheet, including interest rate risk, are not questions that should be driving the formulation of monetary policy. We've seen that in the past in some cases, and it's really a policy blunder when policymakers even think about that. You're supposed to take risks and do what's best for the economy, not minimize your own risks and not do what's best for the economy. Now, relating to the question, is it best to shrink the balance sheet before raising interest rates or not? Actually, there are arguments on both sides of this. So one argument for raising interest rates somewhat before letting the balance sheet run off is associated with the fact that balance sheet policies are still less well understood relative to interest rate policies. So their effects on inflation and the economy 2-3 years out, the monetary policy horizon, are less uncertain. And if you think about having two instruments and one of them can be more precisely calibrated, the interest rate, the other one not so, then it's always safer to start with the instrument that you can calibrate with greater confidence. And this is one of the arguments for why you would want to raise interest rates first before you shrink the balance sheet. But there are pros and cons. So let me remind you one of the consequences of a very large balance sheet. What do balance sheets do? If the central bank buys a lot of government debt, that reduces term premium. Reducing term premium means that you end up with rather flat term structures. Flat term structures do create some difficulties related to financial stability. So there are some side effects that are not as comfortable. The question here is, would you want to live with those side effects for a very, very long time by allowing the balance sheet to stay very large? Or would you want to also reduce some of those risks by shrinking the balance sheet? Again, shrinking the balance sheet doesn't have to mean you sell, shrink relative to GDP. So there are, depending on the considerations about financial stability risks and the specifics of the economy, in some central banks may actually want to be more aggressive in letting the balance sheet ratio to GDP. I think this is a good way to think about it. Shrink faster than other economies.
Let me ask one last question from the audience. There's a person who wants to know about liquidity that's stuck with, he says it's stuck with wholesale dealers. I think you touched on this, Athanasios, when you said the Fed stepped in to help fix the markets, which have become dysfunctional. Can you elaborate on that?
So the only thing I would say there is that there are always, I'm going to call them special factors that you need to worry about, that you need to be very prompt in responding to. If you believe, and this does happen during crisis, the demand for liquidity can increase tremendously. Then the natural thing for the central bank to do, and do it immediately, is to immediately raise the provision of liquidity to that level just to meet that demand, and then do normal monetary policy beyond that. So in the case of the Fed, indeed, some of the balance sheet expansion we've seen in March, April was of this nature. But as Glenn pointed out in his introductory remarks, central banks actually print their own money. So it's not as if you run out of resources to expand your balance sheet to deal with those things. Those things are the simplest things to do. You have people who want to hoard liquidity, that's fine. Provide that liquidity to them, and then provide additional liquidity to expand the economy as needed.
Okay. I would hate for this thing to end. The discussion has been so wonderful, but I've been warned that we're running out of time. So maybe I can ask each of you to offer closing remarks. Athanasios?
Sure. So let me reiterate something I pointed out before. So it's again at his introduction, Glenn pointed out the governance problem associated with balance sheet policies. Balance sheet policies are trickier to run than interest rate policies. In my view, the biggest threat associated with bloated balance sheets would be on the governance side, compromising the independence of the central bank simply because fiscal authorities realize just how powerful the balance sheet of the central banks is. In my view, the best way for central banks to maintain their independence and technocratic approach to policy is with re-emphasizing why they're doing what they're doing, what is the systematic nature of their policies, what is their inflation goal at the end of the day. So I would end by saying nothing about balance sheet policies, whether you do them or not, takes away from the basic principles we know about central banking and monetary policy, that monetary policy works best when it's systematic, rules-based. explain what your inflation objective is, explain that you will ease or tighten policy appropriately in accordance with economic conditions to maintain price stability. And that's the bottom line, with or without bloated balance sheets.
Yes, yes, thank you. Glenn, some closing remarks?
Well, I couldn't have put it better. I think in the end, the world in which we are now living is one where these governance questions and clarity of objectives and independence are critical. And the central banks actually, I think, if they do their job well, they can preserve and enhance their reputation and their independence by being quick to assess the problem, quick to work out what it is they can do, clear about what others need to do. And, you know, in my country, the governor has been very vocal about the need for fiscal support, much more than, you know, he said much more about that than I ever did in my time, because I didn't need to. He's needed to, and he's been very upfront about that.
Yes,
So I
yes,
think
yes, he has.
being clear on your diagnosis of the problem, clear on what you can do, clear on what others need to do, and what success will look like, because we need to define what success is in order to prepare the ultimate road out of this. Hopefully we can find it. They are things that central banks, with their reputation for technocratic prowess and intellectual capital and honesty and integrity, they have a good chance to kind of set the scene. And I think our governor here has actually done a very good job doing that. And that's very helpful for the central bank's reputation ultimately, and I think will preserve its independence and freedom of action into the long run. So I'm agreeing in a long-winded way with what Athanasios already said.
You know, this is the inaugural webinar in our series on conversations on central banking. And thanks to the two of you, we're off to a very good start, a fantastic start. So thank you, Glenn, and thank you, Athanasios. Have a good morning, Athanasios, and have a good evening, Glenn. Thank you very much.
Thanks very much,
Glenn.